Mm, Okay, guys, welcome to today's video. So today we'll be going to be looking at some important concepts in trading. So firstly, I would like us to look at the types of traders. Types of traders. There are different types of traders. There are different ways people approach the market. So in trading, you tend to see on a normal daily life, you tend to see that people's emotions or people's behavior towards lives vary. So the way they approach lives vary. So this also applies to trading. The way people's emotions, how people's emotions, what they are able to tolerate, how long they can stay in a trade, and all of that affects them and categorizes them under the kind of traders they are. The way they take their trades, the time in which they last in their trades, the amount of money they invest in their trades, distinguish them and set them as under different categories of traders. So we have different types of traders. I'll be discussing those traders here in this video today. So the first group of traders we're talking about are scalpers. Scalpers enter and exit trades in seconds to minutes. Scalpers are the kind of people who are impatient. They don't take much time in their trades. Their trades take minimal time, very small time. They can enter markets in seconds and they are out. They can enter markets in a few minutes and they are out. You don't see a scalper holding trades for hours. You don't see a scalper holding trades for a day. Seconds and minutes, a few minutes are enough for a scalper to execute their trades. A scalper focuses on small moves and high frequency. They focus on small moves, few pips. Those are what scalpers look to capitalize on, and they require full focus and fast decision. To be a scalper, you need to be very focused. You need to be fast in making decisions. You need to enter trade immediately. You see them to be able to capitalize on the opportunities in the market, because as a scalper trading some of these volatile pairs, you can think of it, you can see what you are seeing, you can see an opportunity. But if you are not able to act fast, if you are not able to take your decision fast before you even place your order, it's either the market has already run to your stop loss, to your take profit, or you are entering at a very wrong time. So those are scalpers. Scalpers don't waste much time in their trades, and they are really fast decision makers. So the next group of traders we'll be looking at are the day traders. Day traders open and close all trades within a day. Day traders, like the name implies, their trades run for a day. They can open their trades in the morning, close it in the evening. Their trades don't run for more than a day. They don't take overnight positions. They don't stay in trades overnight. That's till the next day. They take their trades from morning, in the evening they are out, and then they wait for the next day. You need a clear strategy and market timing. You have to be patient to be a day trader. You have to be able to control your emotions to be a day trader. So day traders, they open and close their markets within a day, no overnight positions, and you need a clear strategy and market timing. The next type of traders we're looking at are the swing traders. They hold trades for days to weeks. All swing traders do. Swing traders can hold their trades for a couple of days to maybe some weeks. They capture minimum 10 moves. Best for people with limited time but solid analysis. Swing traders are mostly for people who don't have time to really sit and analyze the market all the time. So they just analyze it from a bigger perspective and take their trades at the best entries. So as a swing trader, you can be in a market for some days, you can be in a market for some weeks, and you capture a minimum 10 moves. 10 moves that range from days to weeks Those are the kind of moves, swing traders take in the market. So the next group of traders we'll be looking at are the position traders. They hold trades for weeks, they hold trades for months. Position traders can stay in trades for a very long time. One trade can run for a very long time. They focus on fundamentals and large trends. They are very patient, less affected by small price swings. Position traders are very patient. We should take note of that. Position traders are very patient. So you have to understand the time, your style of trading. You have to understand yourself and know the kind of trade that you fall under. You have to understand what you can tolerate with the market. You have to understand the number of days, the number of hours, the number of minutes you are willing to let your trades run to know the type of trader you are. You have to understand your patience. You have to understand your emotions when you are trading, to be able to understand what you can do as a trader, or how long you can stay in your trade and all of that, to be able to know what type of trader you are. So find your style, master it, and stick to it. That's how you build consistency for traders. So from here, I think we can identify ourselves, what kind of traders we are, to be able to approach the market. Understanding market structure. This is a very important aspect of trading. Market structure is the foundation of price action trading. It shows how price moves and helps traders find smart entries and exit. You don't see the market move in a straight line up and then it starts falling down in a straight line. No, market moves up in trends, and then moves up in trends. So the components of market structure, we have higher highs and lows. That's what you mark up when you are looking at market structure. See, the market forms highs and lows, highs and lows, highs and lows. So price creates higher highs and higher lows in an uptrend. That's when you see the market start to go up. You see them create higher highs and higher lows. Look at this, is an uptrend. It moves up and comes down, and a higher high has been formed. At the moment it moves up again, passes above this previous high, a higher low has been formed down here, and you see it has moved past the previous high, and then it goes down again. Another higher high has been formed, it goes up again, a higher low has been formed. That's how price moves in an uptrend. So in an uptrend, you tend to see higher highs and higher lows, higher highs and higher lows. And then price forms lower lows and lower highs in a downtrend, lower lows and lower highs in a downtrend. So when, for example, this trade moves down, moves back up, it has formed a lower low at this point, and when it moves down again, it has formed a lower high at this point, up like that. So that's how the market structure works. Those are the kind of things you look out to know what type of trend you are in. When you approach the market and you see lower lows and lower highs, lower lows and lower highs, you know the market has started going forward. It is moving in a downtrend. When you see higher highs and higher lows, you know the market is in an uptrend. Then trends. So in an uptrend, higher high plus higher low is what makes up an uptrend. In a downtrend, lower high and lower low is what makes up a downtrend. And then we have also what we call consolidation. This is where you don't see, there's no clear direction where price is moving. It's actually moving sideways. You see here, the market moves up, comes back to this previous point where it touched before, and still moves up direction, like it wants to create maybe a higher high, and it still goes back to this point where it previously touched, and it still go back. So during the consolidation, the market tends to move in a sideways direction. There is no clear direction where the market wants to go, and in this kind of place, although there are a certain type of trade, like day traders can capitalize over this consolidation if they see their structure well, and scalpers can also do so. That's if consolidation is happening in the lower time frames for them. So during consolidation, you have no clear direction. The market moves sideways. You cannot identify your higher high, you cannot identify your higher low, you cannot identify your lower high, you cannot identify your lower low. So those are the three trends that we'll be discussing here, and then we'll move next. We'll be looking at break of structure. What is a break of structure? So when a major high or low is broken, it signals a potential trend reverse or continuation. So this, I'm going to explain this. You approach the market and you begin to see higher high, higher lows, higher high, higher lows, higher high, and you are rest assured the market is going in an uptrend. Definitely is going in an uptrend. So but the moment you see the market at a point from a higher high, it goes down to break the previous higher low. That if it has gone below the previous higher low, that's what we refer to as a break of structure. Look at this point, it went up this high and came back to break this higher low. Once at this point where it broke above it and it broke below it, you refer to it as a break of structure. This structure has been broken completely. You might be expecting this trend now to change, start creating a downtrend. And also for a downtrend, this is how it works. A market's in downtrend, you are seeing lower lows, lower highs, lower lows, lower highs, lower lows. And the moment it moves back to break the previous lower high, you have seen a break of structure at that point. So this is how market structure works. This is what we refer to as break of structure. When the market breaks a previous higher low in an uptrend, or it breaks a previous lower high in a downtrend, refer to it as break of structure. Then why it matters? Okay, it helps you identify where price is heading. It tells you when to enter or stay out of the market. No structure, no trade. If you don't understand structure, you can't take your trades. Structure is very, 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 very important. The structure, you know where to enter, you know where to exit, and you know where the market is heading. For example, at this point, if you make your entry maybe halfway here, market might still fluctuate maybe around this area to this point before still moving up to this place, because this structure I'm telling you about, these higher highs, higher lows, they don't just happen only on one time frame. They happen in all the time frames. So you might see market fluctuates around this area before still successfully moving to this point to make this overall higher high and still higher. So if you can't make accurate entries, structure makes you to be able to take accurate entries. You'll be stopped out each and every time. So this is higher high, you watch it come down to this point and you make your entry at this point, you see an impulse and you make money off of it. That's how the market works. Impulse, continuation, correction. That's how it works. So you don't make money on the impulse, you don't make money on the correction. What you make money on is the continuation, which is at this point. So that's what the market structure helps us to do. So if you can read structure, you can predict where the market wants to go before it gets there. So structure is very important. Then we'll also be looking at time frames. Understanding time frames. Understanding time frames helps you see the bigger picture and fine tune of your entries. Time frames. The market has time frames. So common time frames we'll be looking at, we have the monthly / the weekly. These are big picture trends used by position traders. Daily, we have swing trading direction, 4 hours and 1 hour. We have market structure and trend confirmation, 15 minutes, 5 minutes, 1 minute. Entry exit points used by scalpers and day traders. So these are the different time frames we have in the market. You can also see 1 minute time frame, you can see 2 minute time frame, but these are the basic time frames we look at. And structure can be seen in each and every of these time frame. If you go to the monthly time frame, you will see some higher highs and higher lows. Most of the daily higher highs and higher lows are still found there. Most of the 4 hour, 1 hour higher highs and higher lows are still there, 15 minutes and so on. There is structure inside of structure. We should always take note of that. There is structure inside of structure. So you have to be able to understand structure in each and every time frame you'll be using to trade, to be able to take advantage and make the best of moves. Your entries will be sharp and your exits will be accurate. So that's it for time frames. So how to use them together? Top-down analysis. You start with the higher time frames to see trends, maybe the daily or 4 hours, depending on the kind of trader you are. Move down to refine entries. From looking at the outer perspective, you can now go down to refine your entries, maybe on the 15 minutes or 5 minutes. I said depending on the trader you are. Most people won't take their trades on the 15 minutes. Most people won't take their trades on some traders won't take their trade on the 15 minutes, not even on the 1 hour. So look for structure alignment and break of structure at multiple levels. For example, you can see when we spoke about break of structure, this lower low, lower high, lower low, lower high, lower low, and there's a break of structure at this point. So where there's a break of structure at this point, you are looking for a retest back around this previous lower high. They are looking for a retest there, and once you retest there, you begin to see weakness in the movement of price. You know it's going to shoot up in an uptrend. So these are kind of things you have to look out for while approaching the market. So let the higher time frame be your guide, the lower time frame your sniper scope, the place where you make your entries, the place where you execute your trades. Look at it from the bigger perspective, then you execute the smaller perspectives. That's how time frames help us to approach the market. So another thing, we also have support and resistance zones. Support and resistance zone. Okay, support zone is a price level where buyers consistently enter, preventing price from falling lower. Thinking of it as a floor, is a point below where whenever price hits, it tends to bounce back in an up direction. Whenever price is in a down direction and it hits that particular point, it tends to jump back up in an up direction. So you can think of it as a floor. You can watch for reversals or breakout there. The market can reverse at that point, hit it and jump back up, or the market can break that point and retest to still continue in a downtrend. You don't just see what you think is going to happen. You watch it happen and you execute. So you cannot be giving 100% assurance that the price will always respect those zones. but you look at it that in previous time market has come to that point. So you see a possibility of it coming to that point and still acting the way it did before, but it's not 100% chance that it will do like that. You can still expect it to break below it and retest to still continue it in its downtrend. So that's what we refer to as a support zone. Price bounces up multiple times off a level. That's a support zone to always push up high. So we also have a resistance zone, a level where sellers push to enter to push price down. Think of it as a ceiling. It's if price keeps hitting and failing to break a level to move above that price, that resistance break above, it can flip it to new concept. So this is a ceiling. You can see each time price comes to this point, it only broke out here once, still came down, but each time it came to this point, it reacted to push back down. Each time it came to this point, but for about 3 times it reacted to push back down. So you should know this place is a strong area of support and after also act as resistance as well. This area you should know is a strong area of resistance. Rather, this area here is a strong area of resistance. You should note, since for a couple of times it came and couldn't break above this area. So your zones can act as support and can still act as resistance. For instance, look at this point. This is the market came here, hit this point, went back down. It has acted as a resistance level. It still shoots back up, broke this level, still came down, broke it downwards again, still came to hit it and still acted as resistance, still came down, came again to hit it, acted as resistance for this 3rd time, still came down, broke above it and came down and hit it, and it also acted as support. So at this point here, the markets no longer, this zone no longer acted as a resistance level alone, but also acted as a support level to shoot price higher. So whenever you see a breakout of these zones, you expect to see a retest of those zones to be able to confirm your entry for a push up of a higher movement in price. For example, look at this point, it broke out but still broke back down again. So you should always take note of how the market moves at these points to be able to make capitalize off those entries to make the right entries. So zones are not exactly lines. Treat them as areas. Just don't forget that I drew these things as lines. Zones can be areas. You can draw them as boxes along this way, no matter what. Maybe when it comes to this particular area, this is how it behaves and all of that. So zones are not just exactly lines. They are areas. You can combine them with structure and time frame for higher accuracy. You join them together as one of your confirmations to be able to take trades. So don't trade every touch. Wait for confirmations. Wait for other confirmations apart from this to be able to validate your entry. So that's it for support and resistance. So entry and exit based on structure. Entry and exit based on structure. Using structure and key zone to enter and exit improves your precision and confidence. Like I said, structure is very, 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 very important. So here's maybe an entry strategy. I'm giving you some example of entry strategies you can be using. So we have the break and retest. You wait for price to break a zone, then retest it. You wait for price to break a trend line and then retest it. You wait for that price to break structure and retest it to enter for either buying or selling. Enter on confirmation, like a bullish, bearish, engulfing candle. Enter on confirmation. you should always enter on confirmation. For example, you look at this candle right here. These are candles. So this is your candle. This is the body of the candle. This thick red box you can see as the body of the candle, and this line in the middle here will refer to it as the wick. So, and this candle is red, so you might as well know it is a downtrend candle. This is a bearish candle. So this candle has opened from around this point, this top point here. It came down this low to this point, but still came back and closed at this point. This is at the time when this particular time, so if it was a 5 minutes time frame, at the time when 5 minutes exhausted, within those 5 minutes, this is how low the candle came, this is how high it went, but this is how it closed. It came down and closed at this point. Meanwhile, it opened at this point. So for this kind of movement, when you see maybe I am in a downtrend, I broke structure going towards an uptrend, and I came to retest, and I begin to see candles like this, I will know there's now weakness in downtrend, and I'll be expecting a full uptrend when I begin to see things like this. And also this is for the bullish candle. This candle has opened from around this point down here. It came up this high, came down this low, but closed around this point. So if I am in a downtrend, if I'm in a downtrend, I break structure and I begin to see things like this, I'll see them as some of my confirmations. So we can also see candles such as these candles, they are full candles. You begin to see that yes, this is a lot of buyers in the market, and when you see red ones, you begin to see that yes, these are a lot of sellers in the market. So we should also take note of these little things. So trend line or structure bounce, enter on touches of trend lines or major highs and lows. That's another thing we can enter from trend lines. So entry and exit based on structure. Exit strategies, we discuss entry strategies. So exit strategies: set take profit at zone levels, use nearby support and resistance for previous price. Whenever you take a trade, your target should be the next zone. Support or resistance zone closest by, to be sure that yes, this share market is going to be sure of where you are heading to next. Then trailing stop loss, lock in profit as price moves in your favor. When you lock in profit as price moves in favor, you'll be rest assured that even if price wants to reverse against you, your trailing stop loss will always be outside and you will always end up in profit. And then exit on structure break. Once you enter a market and you see the market flips on you and there's a structure break, you might as well consider exiting that particular trade, because you might just lose more if you consider staying in longer. Don't enter because you are eager, enter because the structure and zone agree with your plan. Don't enter out of your feelings, don't enter based on how you feel, enter based on what you are seeing, enter based on how structure and the zones agree with it. So that should be your entry and your exit strategy. So next we go into trend line. Trend line help you visualize price direction and dynamic support and resistance level. A trend line is a diagonal line that connects two or more swing highs or lows, showing the general direction of price. Okay, for example, look at this. This is in an uptrend. This is an uptrend. This is an uptrend. Your trend line comes from here, passes through here to touch this lower lows. So at this point, whenever price comes to this point, it bounces off, comes to this point, it bounces up, comes to this point. So we are expecting that when this price comes down again towards this line, when it reaches this line, it will still bounce off. So that's how trend lines work. And in a downtrend, it's also same. It's going up, down, touching here, bounces down, touches here, bounces down. So you're expecting that whenever it comes up to this level again, it will bounce down. So that's how trend lines work. We have types of trend line. The uptrend line, which is bullish, connects higher lows, acts as dynamic supports, connects higher lows. And then downtrend line, bearish, connects lower highs, acts as dynamic resistance. How to use trend lines: use at least 2 to 3 valid touches to confirm a strong trend line. Wait for rejection candles. Wait for the candles. Like I said, I showed you the type of candles. Wait for rejection candles at trend lines before entering. Combine with structure and zones for high probability setup. Always bring all your confirmations together. One confirmation should not be telling you a different story. Everything should be telling you one story, so you need to confirm your entry, the success of that entry. So for this video, we're able to look at types of traders, market structure, time frame, support and resistance, entry and exit strategy, and trend lines. Structure brings clarity, entries bring precision, psychology brings results. So let's watch out for the next video, and thank you for watching.